Now, of course, not unusual to give out stock as incentive, but this is the first time it's going to all full-time employees at once.
And the manner in which it was done in an all-hands meeting, pulling everybody together, saying, we're going to give you money. We're going to give you more money, don't worry. I think there are a lot of things to pay attention to here with this company. And one is just kind of the culture of Silicon Valley, which is people come to work here typically taking lower salaries than they might get elsewhere with stock options or restricted stock shares as a way to reward them. But the reward doesn't mean much when you have a falling stock price, which is what we've seen from Zynga. If you look at what's gone on with that stock price since the IPO, remember, it actually rose. It went public at, I think the initial evaluation was $10 a share. It went up for a while there, but nobody could sell. And people may have made certain plans, bought houses, other things that employees do with those kinds of stock options. And I think it's also worth noting that Mark Pincus did sell and sold a lot of shares personally. So the CEO of the company, while everyone else was restricted, was selling shares before the IPO, was selling shares significantly. He sold 44 million shares before the IPO. The prices, we don't know exactly what he got for them. The price was, in the filing, says between 42 cents to $13.96, which is to say he sold somewhere between $18 million and $609 million of stock before the company ever went public. So he cashed out while employees were forced to stay in, and even some employees had their stock option grants reduced. And I think that that's something, the context here is very, very important.
And he also sold stock last quarter before the earnings report when the stock was a lot higher than it is right now.
They did a big secondary offering that allowed some venture capitalists to get out. And once again, you had Mark Pincus as a really big seller there. And those insider sales were significant for the company. I think if you look at the number there, the share, it's hard to believe right now at $3 a share price. Back in March, it was a $12 share price. There were $213 million in insider sales. And this is at a time when the rank and file of the company were locked up. They couldn't sell shares. We had some of the senior executives selling shares.
So who else other than Pincus sold?
So in addition, so Mark Pincus was the biggest shareholder, a seller in that secondary offering.
And is still the biggest
by
shareholder.
large, yes. And it has control, a different kind of control of the company in a different way. It's another story for another day. But David Warner, CFO, selling 5 million shares. Reggie Davis, the general counsel, selling 4 million shares. So you had just a handful of insiders selling a ton of stock when everyone else that they work with was restricted from doing so.
Now, you did a really interesting piece last week on Zynga's fuzzy sort of accounting methods. Does that have anything to do with what's going on here?
I think so, because they were required. They say they were required to do this accounting change to shorten the time period, the length of customer, their estimates on the length of customers. But it did have this effect of making the results at a pure optical level look a little bit better than they were, particularly going into the IPO. It created some profits where there wouldn't have been profits without those accounting changes before the IPO, when you had Mark Pincus as CEO and a couple of other executives changing the accounting rule, the accounting treatment, and creating a sense of profits where there in fact would not have been profits without that accounting change.